Parliament Standing Committee on Finance comes down heavily on the Reserve Bank of India, asking it to review its capital adequacy norms for banks, dubbing the current rules as unrealistic and unwarranted. The panel is claiming that as much as 5.34 lakh crore worth of funds will be freed up if these extra capital requirements are waived. Bankers meet to talk restructuring of power assets worth over 50,000 crore rupees outside the IBC framework. Efforts are on to build consensus among lenders for the execution of a resolution plan. Fresh legal tangle for the makers of Maggi. The Supreme Court revives the government's suit against Nestle, allowing the Consumer Court to restart hearing in the case. The centre is seeking damages of something like 640 crore rupees on charges of unfair trade practices, false labelling and misleading advertisements. H.S. Fulka, senior advocate and MLA in Punjab Assembly, quits the Aam Aadmi Party, saying he'll hold a press conference tomorrow to explain his reasons. Sources claim Fulka is upset over the controversy surrounding the Bharat Ratna withdrawal of late Prime Minister Rajiv Gandhi. Kerala witnesses a virtual shutdown as right-wing groups protest over the entry of 2 women into the Sabarimala shrine. 1 person is dead, as many as 300 arrested in connection with violent protests. Kerala police launch a special drive, Operation Broken Window, to crack down on protesters. For the first time since the launch of the iPhone in 2007, Apple issues a profit warning citing economic deceleration in China. Shares of the tech giant cratered 8%, knocking $50 billion off its market cap. And Cheteshwar Pujara leads the way for Team India on day 1 of the Sydney test against the Aussies. Pujara scores the 3rd century of the series. India have ended the day with a formidable 303 at the loss of 4. Hello there, very good evening. You've joined us right here on the India Development Debate. I'm Taneia Bhardwaj, coming to you live from our Mumbai studios. Now, it's a shot in the arm for the Modi government that's been at loggerheads with the RBI for not doing enough to spur growth until recently. The Standing Committee on Finance, headed by veteran Congress leader Veerappa Moily, has virtually endorsed the centre's stance that banks are choking thanks to the RBI's stringent capital adequacy norms. According to the panel, the additional capital requirement, which is beyond the Basel II guidelines, is unwarranted, as international operations of most Indian banks are minimal, raising the red flag on huge loan write-offs. The panel says instead of helping them to come out of the mess, the high bad loan provisioning has in fact eaten into banks' earnings. The report's gone on to say that the revised PCA framework may have only worsened finances of banks that were already on the brink. In fact, speaking exclusively to ET Now, Mr. Moily also said that the panel has suggested that the PCA norms be lifted to facilitate credit flow into productive sectors. Another important suggestion is for setting up of an expert committee to study the IFRS norms in an Indian perspective. Interestingly, the panel says the development financial institution architecture may be reintroduced for long-term finance in industrial and infrastructure sectors. The House panel recommendations for the revival of the banking sector is what we're debating this evening on the India Development Debate. And joining in for that, our consulting editor Maithili Pusnurmath. We've got Charan Singh, he's Chief Executive at eGrow Foundation and also Non-Executive Chairman of Punjab Sind Bank. Somnath Mukherjee, Managing Partner of ASK Wealth Advisors, is here with us as well. All three of you, good evening and thank you so much for sparing the time. Maithili, let's start by the parliamentary panel, seemingly sort of backing the centre's stance that banks are choking thanks to the RBI's stringent capital adequacy norms. Does this somewhere maybe vindicate the government's stand, you think?
Oh, well, yes, it certainly does vindicate the government stand. And what is interesting, Tanya, is that, the Parliamentary Standing Committee on Finance is headed by the opposition member. Mr. Veerappa Moily is from the Congress Party. So for the first time, we are seeing some kind of bipartisan position on the issue of bank credit and the issue of NPAs, PCA, etc., which we hadn't seen in the past. So that is a very welcome move to start with. Secondly, yes, the parliamentary committee does have a point when it says that the RBI's PCA norms were rather unimaginative, textbookish and theoretical, because in the process, even though the attempt might have been to get some of these banks, which were clearly not in the best of financial health, to get them to kind of improve their health, the process was a larger economy, the larger credit offtake from the system completely almost froze. There was a sharp reduction in the credit offtake from the system, and the entire economy as it were, has suffered the consequences. So clearly, when the Reserve Bank takes some action, it's necessary for it to take the larger picture keep the larger picture in mind, and that it clearly hadn't. So there is a case for rethinking the PCA norms, and if not going to the extreme of allowing complete forbearance, there must be some middle path between a very stringent approach and a complete free-for-all. So I think there is a point that the Parliamentary Standing Committee is making, which is a point which many observers have also made, and I think the RBI also, particularly now that it has a new governor, takes a slightly more pragmatic view and sees how can we have the best of both worlds, get these banks to perform, improve their financial position, and at the same time ensure that the entire system does not get penalized in the process.
Charan Singh, let me ask you the same question. You know, the panel is called the additional capital requirement unwarranted and unrealistic. The call for a relaxation is also coming at a time when, you know, the RBI, in the defense of these supposedly tough rules, has said that, look, if we lower these capital buffers, it's going to be detrimental both to the economy as well as lenders. You know, as Moily said, the need of the hour really is a pragmatic approach. What can be a pragmatic approach here?
So, first of all, I would like to mention that I'm joining more as a chief executive of the eGrowth Foundation,
sure,
and speaking not on behalf of Punjab Sind Bank, of which I happen to be the non-executive chairman. So I'm speaking more analytically and speaking more like an economist rather than anything else. Now, I'm totally in agreement. I have myself been saying that the PCA norms were too stringent, and they have been applied to banks where it need not have been. The point that I'm trying to make is little different. I'm saying that the Basel norms, capital adequacy ratios, these are too stringent for many banks in the country. And why I say that is, if you look at the Basel norms as they stand, where was the need to have these adequate or robust buffers over and above the international standards, given the fact that many Indian banks do not have an international presence. So the point I'm making is that if the banks had an international presence, I can understand that they have to compete with the Basel norms where international banks are involved. Secondly, and that is a very important point according to me, when the ownership system of banks in India, largely public sector banks, government owned, that's already a safety valve. The third thing, we have such high SLR ratios. SLR ratios already provide a very big buffer to the banking system. Over and above this, if you say that the risk weights and capital adequacy ratios have to be much above the international standards, I think that's not fair. When it comes to the PCA norms which have been decided on the basis of the Basel norms, which are already super high for banks in India, then the same issue comes up again. That is why I say when 11 out of the 21 banks are under PCA, and the credit is obviously the first thing that is impacted, how do you expect credit offtake to take place in the economy? Now, I'm absolutely in agreement that if you take the bigger picture, the bigger economy in mind, the time when credit offtake has to be large, you say that 11 banks are under PCA and they cannot lend. What happens to the economy? What happens to employment? What happens to economic activity? So therefore, I think the whole gamut of things need to be revisited, just not the PCA norms and the capital adequacy ratio, the Basel norms. All these need to be revisited once again. And I have the last point that I would like to make. I'm really very worried about one thing. In India, not one, 4 banks have a history of more than 100 years. Punjab Sind Bank has a history of 111 years. State Bank of India about 200 years, Allahabad Bank and Punjab National Bank more than us. Even Canara Bank has a history of more than 100 years. These banks have seen the test of time. They have seen the world wars, they have seen the Great Depression, they have seen the partition of the country. Yeah? And now, given the situation, I think Indian banks, public sector banks should set the norms. Rather than Basel norms, they are owned by the government, New Delhi. They are regulated and supervised by the Reserve Bank, Bombay. Instead of Basel norms, I think we need New Delhi, Bombay norms.
All right.
And we should tell the world how to save a bank and how to let the bank thrive.
Okay. Mr. Somnath Chatterjee, let me ask you, you know, the parliamentary panel also believes that the capital to the tune of something like 5.34 lakh crore will be freed up if these supposed stringent norms are relaxed, if we were to align with global standards, do you think banks will be able to lend more?
Yes and no. To start with, as Mr. Singh just mentioned, 70% of the Indian banking system is sovereign owned, and capital adequacy is essentially a way to comfort and reassure depositors to the banking system. But depositors to Indian banking system, certainly the public sector banking system, anyway are comforted by the fact that the banking system itself has a contingent put on the Government of India, in which case really the capital adequacy of a public sector bank is less relevant to the health of the bank as is some of the other parameters like loan growth and revenue growth. Because essentially you don't see any run on a single public sector bank that we've seen. We've had public sector banks in the last 3 or 4 years with gross NPA levels well into double digits. You have a certain number of banks in PCA. Most of them have gross NPA levels of 10 to 20%. Do you see any run on a single bank? You don't. Do you even see deposit pricing on any of these banks dramatically shoot up? We don't. The reason is that depositors are reassured by sovereign ownership of these banks. So there is a contingent put on the Government of India. So pegging on Basel capital norms on top of that really is a question of overkill, simply because theoretically or practically the deposit protection is essentially a contingent liability of the Government of India, and hence the capital could perhaps be better used by expanding the balance sheet of the bank or the lending book of the bank itself. Now I am a little less worried about the general concerns being expressed around the credit offtake. If you see the data in the last 3 or 4 years, while bank credit has certainly gone down, they have been replaced by alternative sources of funding, whether it is non-banking financial companies, mutual funds, alternative investment funds. So if you take all of that into account, the demand for credit has more or less been met by supply. So the issue is not so much about aggregate supply of credit as it is about the health of the banking system per se. Okay. So I think to that extent what the Parliamentary Committee has said now it does make a lot of sense.
Okay. Maithili, the panel is also calling for the re-evaluation of the NCLT. How would you rate the performance, as far as recoveries have gone? Just today you had the Finance Minister sort of in a very exhaustive blog post detailing how the NCLT had helped, creditors recover something like 80,000 crore rupees, another 70,000 crore was most likely by the end of March. Despite the legal roadblocks, would you say it's been a job well done?
Taneia, before I reply to this question, I just want to add a slight clarification to the issue of capital adequacy. I know both the other two panelists felt that there is no need for capital adequacy for Indian banks, but I would like to put a slightly more nuanced picture, because the fact is that in a globalized world where we have so much of dealings with other banks in other countries, it's important that those banks which are internationally active, those necessarily must comply with standard norms, international norms. So for those banks which are internationally active, and there are about 4 or 5 of them who open letters of credit, etc., I think for them it is very important that they comply with Basel. But Basel Plus, I think, is not really quite necessary even for those banks. For the banks that are not internationally active, maybe there is a case for not being so particular about whether you comply with Basel or not. So I think one needs to take a slightly nuanced view as far as capital is concerned. On your specific question about the NCLT and the IBC, how has it performed? I would say one significant achievement of the IBC and the setting up of the NCLT and the NCLAT is that it has dramatically changed the equation between the borrowers and the lenders. Unlike earlier, when the lenders were at the receiving end and the borrowers, particularly defaulting large promoters, could really do whatever they felt like, that has changed completely. Today now, I think borrowers will think twice, maybe 10 times before they default. So that has sufficiently changed, and lenders are much more empowered. To the extent that the NCLT and the IBC has not been able to stick to the timelines, which were fairly ambitious to start with, I think that is a bit of a letdown, but this is still a work in process. And I think another part of as far as the NCLT is concerned, I think section 29A, which virtually ruled out almost all kind of serious bidders, people who were in a position just because they were somehow connected with the defaulting promoters. I think that section needs to be rethought. We also need, I think, as the Parliamentary Standing Committee has also suggested, to clearly distinguish between those who are willful defaulters and cases of default where it was not because of any deliberate action on the part of the borrowers. So I think we need a lot of fine tuning, but one significant achievement that I reiterate is that it's changed, completely altered the equation between the borrower and the lender. The creditor is now much more empowered than in the past. But it is a work in process. We'll have to still continue to fine tune it to ensure that it delivers as per the very high expectations with which it was started.
So now, Chatterjee, let me ask you about the IBC again. The Parl panel is asking for, a reasonable base price for any bidding, and the rationale there is to avoid large haircuts. Is the committee being a bit harsh in its assessment of the IBC process, which is just about started?
I would say so. I would agree with that. Remember, this is an extremely new law. It's barely been a couple of years, and like any other law, they need to be tested not once but quite a few times in the judicial process for the precedents to be set, for the market participants across the board, whether these are investors, whether these are creditors, the resolution consultants, etc., for them to arrive at standards, rules of engagement and procedure. So the fact that it is taking a bit of time is not surprising. The fact that the law is discovering itself out in terms of what is possible, what are not possible. And remember, we've also seen changes in the law in the interim as well. We had an amendment that prevented promoters from taking back the companies through a bid later on through the process, and so on and so forth. So I would say that they should let the law and the process play itself out and evaluate the outcomes probably a couple of years later when we have more data. The other thing is we still have very thin data on the number of cases that have been resolved, of the haircuts that banks have actually taken. The data is not even running into 3 figures right now, the number of cases that have been truly resolved through the process. So a lot of it is work in progress, and there is merit in letting it work itself out.
Mr. Singh, the report also sort of suggests somewhere that maybe the central bank has been a bit too tough in its fight against bad loans. Again, the panel is, not only asking for a relaxation in the PCA framework, it's also asking for a review of RBI circulars, transparency in identifying NPAs, and also sort of calls for, any avoidance of knee-jerk reactions like stopping of LOUs. What is your assessment? Do you think that the RBI may have acted in a bit of haste in resolving the NPAs, or is this criticism, basically to just sort of, shift the political blame?
Well, the RBI is really very professional, and I've been in the RBI for a couple of years. I can tell you the training and professionalism at the RBI is really very, very high. The fault lies in the Basel norms, and the fault lies in the mechanism and the supervisory and regulatory role that we have given to the RBI. RBI will follow the rule, whatever you tell them, RBI professional officers that they have to follow those rules. Now, I'm going back a little back. Earlier, as I mentioned, that in India we have banks which are more than a century old, and the Basel norms which are being imposed on the Indian banks are being imposed by countries where banks don't survive at all, even a decade. Every 10 years they have a major financial crisis. Now, to my mind, that's very funny that countries which have not been able to regulate their banks, supervise their banks, or even have healthy banks, they are prescribing rules for India. That's one thing. Secondly, when it comes to the RBI's role in terms of being a little harsh, I would like to mention very clearly that the RBI should have taken into account the cyclical behavior of the Indian economy. If the NPAs are rising, why are they rising? Which are the sectors in which they are rising? These are no secrets. Now later the data is clearly showing that the areas and the economic sectors where the stress was high, and stress could have been high for various reasons. The most important reason is the export sector was suffering. There was international competition. China and Bangladesh in different sectors like steel and textiles were doing something which was not really acceptable. Once you know the sectors in which the stress is there, once you know there's a sagging of the growth and therefore the corporate sector is suffering, and therefore the balance sheet of the corporate sector is really suffering, and that is reflecting on the banking system, I think the RBI should have been much more softer on the NPAs. Now I don't want to criticize RBI, but RBI is also bound by certain rules, and the same rules which I'm trying to say that look into the roots, from where did the Basel norm comes, and where did these norms really come, and why was the RBI not told that you have to go little relaxed in the current circumstances. Exactly what is playing out now. The government is telling the RBI, look, please look at the bigger global picture, look at the domestic economy, and then frame the rules. Now, final point that I would like to make, look at the interest rate story. The real interest rates are so high, and the Reserve Bank has been constantly raising the interest rates. So the whole gamut of things need to be looked into, and the focus has to move into the domestic economy rather than always playing to the gallery of 4 rating agencies and the global economy. Now I fully, and final point, I fully agree with the comments made little earlier. Yes, there is need for differential rates and differential norms in the country. Banks which have an international presence, which have lots of exposure to the export sector, I understand, branches in the outside world, I understand they may have to follow the international norms like the Basel norms, which again I think need to be relooked. The banks which have no international presence, which do not have exposure to the export sector, should they follow the same norms? What for? Who is dictating the terms? Should the 4 rating agencies dictate the terms, or the bigger global economy and the domestic economy should dictate the terms? I think it should be the domestic economy, it should be the growth factor, it should be employment that should determine all these norms.
Maitri, you know, the other thing that the report talks about is this climate of fear among bankers. Is that a real very much issue still? You know, because of the bad loan cleanup and the crackdown that you've seen on errant promoters, you know, there are case